Hello everyone, this is Sumbula FIFA. Welcome back to my channel Me to You Education. In this video, I am going to explain a very important concept of again financial management that is termed as cost of capital. So before starting this video, if you have not subscribed to my channel, please do like and subscribe. Now let's get started with the meaning first. The cost of capital is the rate of return that the suppliers of capital requires as compensation for their contribution of capital. Here I explain you this meaning clearly. See, when the company is in need of funds for its growth, how the company arrange funds? Company arrange funds by issuing equity shares, preference shares, debentures, retained earnings. So all these are the sources of capital which the company issues in the form of physical certificates, and the suppliers of capital, that is investors, that is your equity shareholders, preference shareholders, debenture holders, okay, purchase these securities and provide funds to the company. Company taking these funds, invest these funds into its project, and after some specific period of time, company pays return to its investors. Okay, the return which the company pays to the investors, that return is called cost of capital. Okay, so why the company pays return? See, first of all, the investors simply not invest their funds into someone else's business. Okay, they expect some return. See, if I ask you to invest your money in my business, do you simply get agree? No, right? You ask me to pay some returns of around 10% or 12% on making your investments. Okay, so the return which the company pays to its investors and the return which the investors expects from the company, that return is called cost of capital. And for company, arrangement of funds never going to happen free of cost. When the company borrowing funds from its investors, that means company is basically using someone else's resources. Then obviously it has to pay reward or compensation to its investors as a return. So that return, that rate of return which the company pays to the suppliers of capital, that is to investors, as compensation for their contribution of capital, is called cost of capital. So basically cost of capital is the additional amount along with the principal amount which the company pays to the suppliers of capital. That additional amount is called cost of capital. It's same like when you take loan from bank, you need to pay some certain interest rates, right? Like that itself, when the company borrow funds from its investors, it need to pay returns to its investors. Okay, that return is called cost of capital. The return on equity shares is called dividend, and the return on preference shares is called preference dividend. Return on debt instrument, that is on your debentures or bonds, it is called interest rates. And retained earnings are the portion of profit of shareholders itself which is reinvested into business for future projects. Okay, so all these are the return which the company need to pay to its investors, hence it is a cost to company. Okay, so basically capital is your equity, preference, debentures, retained earnings, and the returns on these capital is called cost of capital. Cost of capital is the minimum rate of return expected by its investors. What is this minimum rate of return? Minimum rate of return is the return which a firm is required to be earned on its investment project. Here I give you an example and explain you this. Suppose one XYZ company borrow funds of rupees 10 lakhs okay, at the interest rate of 12% you assume. So this 12% is what? Is your minimum rate of return. That means in any investment project, a company have to earn 12% or more than 12%, but not less than it. Suppose a company gets a return of 15% in some project. As interest rate is 12%, that means 3% is a profit to company. So company can accept this project. What if the company gets a return of 12%? As interest rate is also 12%, that means neither profit nor loss to company. So this return is what? Your minimum rate of return. Okay, this much a company have to, or this much a company at least earn on its investment project, or more than this. What if the company gets a return of 9%? As interest rate is 12%, that means 3% is a loss to company. So company reject this project. So minimum rate of return is a return which is required to be earned by the firm on its investment to meet the expectations of its investors or to maintain its market value or value of shares. Okay, so this is what your minimum rate of return. More than this, the company can earn, but not less than it. Cost of capital is also called break-even rate, minimum rate, cut-off rate, hurdle rate, standard rate, or target rate required to be earned by the firm to maintain its market value and value of shares. So different authors have used cost of capital in these many different names. Company usually raise capital in the form of equity shares, preference shares, debt, retained earnings. So all these are the sources of capital, and return on equity, that is dividend, is called cost of equity. Return on preference shares, that is preference dividend, is called cost of preference shares, and the return on debt, that is interest rate, is called cost of debt, and the return on retained earnings is called cost of retained earnings, and the symbol of cost of capital is K. So all these are the components of cost of capital. Now moving on to the next, that is determinants of cost of capital. So determination of cost of capital happens in two stages. First stage is called specific cost or individual cost, and second stage is called overall cost of capital, or it also called WACC, weighted average cost of capital. In first stage, you need to calculate cost for each individual source of finance. That is, for equity, you need to calculate cost of equity. For debt, you need to calculate cost of debt. For preference, you need to calculate cost of preferences, and for retained earning, you need to calculate cost of retained earning. So here you calculate cost of each individual source of finance separately. Hence it is called specific cost or individual cost. Why? Because here we calculate the cost for each individual source separately. Okay, whereas in second stage you need to take weighted average of all these individual source of finance, and that weighted average will give you overall cost of capital. Hence the overall cost of capital is known as weighted average cost of capital. Okay, so in first stage you calculate cost for each component separately, whereas in second stage you will combine all the calculation to figure out the total cost of capital on weighted average basis. So this is how cost of capital is calculated. Now moving on to the next, that is importance of determination of cost of capital. So here we discuss why determination of cost of capital is important and what role it plays in the area of financial management. Okay, So cost of capital plays a very important role in the area of financial management. Actually, management always need to keep into consideration this cost of capital while taking financial decisions of the company. Financial decisions like capital budgeting decisions, capital structure decisions, investment decisions, financing decisions, dividend policy decisions, and so on. So all these decisions are made based on cost of capital. So let's know its importance in detail one by one. Cost of capital is helpful in capital budgeting and investment decisions. How? Let's see. Cost of capital is used to calculate present value of cash inflows with present value of cash outflows to determine net present value. If NPV is positive, project is accepted. If NPV is negative, project is rejected. See, cost of capital used to calculate present value of cash inflows with present value of cash outflows, by which NPV gets. Okay, what is this cash inflows? Cash inflows means money or cash is coming into your business. When it comes into your business, when you are getting return on investments, isn't it? Or cash your customer pays for the product you sell is a cash inflows. And what is cash outflows? Cash outflows means cash is moving out of your business. When cash moves out of your business, when you are making payment of salaries to your employees or payment of rent, is a cash outflows, isn't it? So if by this cash inflows and cash outflows your NPV gets, and when the NPV comes positive, project accepted, and when NPV comes negative, project rejected. Okay, when this NPV comes positive, when your present value of inflows are greater than present value of outflows. Okay, when inflows are greater than outflows, then NPV comes positive, project will be accepted. And when inflows are lesser than outflows, NPV comes negative, then project will be rejected. Okay, so here cost of capital is used to calculate cash inflows with present value of cash outflows. By this your NPV gets, and this NPV is used in capital budgeting and investment decisions. So this is how cost of capital helps in capital budgeting decisions and in investment decisions. And the next point is importance to capital structure decisions. So cost of capital plays an important role even in capital structure decisions. Okay, so capital structure and optimal capital structure in detail I explained in my previous video. Capital structure refers, it is a mix or a proportion of different kinds of long-term securities, and a financial manager should have to design optimal capital structure. Optimal capital structure refers sound or good capital structure. Okay, its main objective is to design capital structure in such a way which maximizes shareholders value and minimizes cost of capital. Okay, so a firm uses a particular type of source if the cost of capital is suitable. Okay, this capital structure decisions are made on the basis of cost of capital incurred by the firm. Hence, cost of capital helps to make decisions regarding structure. And the next point, that is importance to evaluation of financial performance. As cost of capital is one of the important determinant which affect the capital budgeting, capital structure and value of the firm. Hence, it helps to evaluate the financial performance of firm too. And the fourth point, that is importance to dividend policy decisions. So cost of capital is also used in the determination of dividend policy of a company. Okay, dividend policy refers what? It is a decision whether the earnings to be distributed or to be retained in business. Retained refers what? To reinvest in business itself, or partly to be distributed, partly to be retained. Okay, and when the company distributes dividend and when it retains, see, if the profitable investment opportunities are available to the company, then company distribute less dividend and major part of the company's income is retained in the business itself.
And if the company does not have an adequate profitable investment opportunity, in such case the company distribute maximum part of its income among the shareholders. Okay. And how the company get to know whether it is a profitable or non-profitable investment opportunities? Through cost of capital. Okay. See, if the cost of capital, if the rate of return is greater than the cost of capital, then it is assumed that the firm has a profitable investment opportunities. Then what? The company retain the dividends, okay, for further investment. Whereas if the rate of return is lesser than the cost of capital, in such case firm assume that the firm does not have an adequate investment opportunities. In such case dividend distributed to shareholders. Okay, so this is how cost of capital is used in dividend policy decision.
Apart from the above points we discussed, cost of capital is also used in some other areas like market value of shares, earning capacity of securities, and so on. So by this we can say cost of capital plays a very significant role in the area of financial management. Okay, so by cost of capital itself, capital budgeting is possible. By cost of capital itself, financial manager can design the optimal capital structure, and cost of capital is helpful in dividend policy decisions. Like this, many financial decisions are being taken with the help of cost of capital.